And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is the managing partner of Asset Preservation Tax and Retirement Services. Stewart, it's so good to see you again this week.
Absolutely. Same here.
How are you doing?
Man, I'm busier than I've ever been. My Saturdays are now filling up from appointments. I know. I don't know if my wife's just trying to kick me out of the house here by getting rid of me on Saturdays, but you know, we
definitely not.
It's no,
She's definitely not doing that.
We're staying busy for sure.
Absolutely, and you're actually balancing appointments around basketball schedule too, which I think is incredible. So you're still able to go see your son play, and then you're coming to the office. I mean, you really have your hands full right now.
Both of them are playing now, and it's just it's between club basketball, high school, varsity ball, the whole thing. It's all over the place.
Absolutely. So in case someone is just tuning in for the very first time this week, because maybe they're traveling or they're just coming back or what have you, I want to talk a little bit about just your office specifically, like the two locations that you have. Let's talk a little bit about what it feels like when someone is working with you and what the office feels like in both locations.
Sure. Well, the one thing that kind of separates us from other financial advisory practices is that we are a complete shop in the sense that we have a full tax office in our office here. It's the headquarters are based in Sun City. We also have our office in Scottsdale, but we are a full estate planning, financial planning, and tax planning office. So, oftentimes people will talk about being tax efficient and so forth, but they really don't have the resources as a financial advisor to really know for certain what the impact of certain results will be. What we're really good at doing is not only just preparing the tax, but once we have that tax data, what we can do is we can model out different scenarios to find out, does it make sense to look at Roth conversion? Does this sort of advanced tax planning make sense? And we can show you to the dollar exactly what it'll cost you, where most people are just kind of guessing. And when they guess is when they get into trouble. That's when we've seen people that have gone over the Affordable Care Act thresholds by just a few dollars and had it completely pulled back. I mean, there's a lot of thresholds you don't want to cross when it comes to income, and we certainly don't want to make a mistake by getting them to cross it.
Sure, absolutely. Stewart, let me ask you, how does someone know that they're ready to retire? What kind of questions should they be asking if they're thinking about retiring?
Well, the first thing they need to know is they need to understand what their current income looks like now and what it looks like in retirement. And I think that that's the biggest kind of area that they get lost in, because you do have to look at Social Security. You have to look at, your pension income, if you even have one, and your retirement income, et cetera. So you want to put all that data together and draw a picture, create this illustration of what life's going to look like when you're done working. And for some people, I just met with a client the other day, they're going to have more income when they retire than they make now. And he's like, yeah, but I don't think I'm ready for retirement. Well, there's two things when it comes to being ready for retirement. Are you financially ready? And then are you psychologically ready, right?
Definitely.
Because what I do see is that people that work later in stress-free environments, they actually live longer because they're keeping their minds active, they're staying busy. Look, we're in the snowbird retirement capital of the world here in Arizona, and we tend to see people that come in after they've acquired all their assets, they're looking for planning, real planning. Well, the nice thing is now with the television show here over the last year is that we've really been able to reach out to people that don't go to the seminar workshops. They feel like, hey, that's just for old people, and so forth. But we get a whole different group of people to come in from, our average client is 65 years old, and, we have clients all the way, we have one client that's 101 years old, and we have, tons in between. But it's really important to have a plan, to know what the impact is going to be if you're done working. Are you going to be able to pay the bills?
Yeah.
Because it's a lot harder to go back to work at 75 than it is to keep working at 62, right?
Sure, absolutely.
And sometimes, I have to be honest with clients. I have to sometimes tell them, you know what, you need to work for another year or two because you can't afford health care because remember, Medicare doesn't start till 65.
Yeah.
So it's just really important to get a real understanding. And I think that what a lot of people have seen is that their financial advisors have just kind of abandoned them in this volatile environment. They're just not getting much help from planning. A lot of them pay attention to the investments, and that's it, because that's where they get paid. But really, it's the other planning that really matters the most. We don't charge any sort of fee for our additional planning, but we only do that planning for our existing clients. So it's really important to make sure that if your advisor is making money off of handling your accounts, that he's actually adding some value, not just being parasitic to the situation. Because if they're going to take money out of your accounts, either through fees, commissions, they're going to make a living on you, they need to show something in return for it.
Absolutely. I should ask you, Stewart, how important is good communication between an advisor and the client? How often should they be hearing from one another, if you will?
Well, this year has been a little weird, even for us, for a couple reasons. Number one, we usually have 3 or 4 events during the year where we have our Christmas party. We rent out the Arizona Broadway Theater, and this year we had it reserved for two separate events during Christmas time. And they hold 450 people, so we were expecting like 900 people at our 2 events, and that isn't the whole purpose of that. It's just an excuse to have another conversation. So after tax season's over, we have gourmet food trucks, those amazing food trucks.
Yeah, those are fun.
Yeah, we have them come to the office in a shredding truck, and at first it was all about just shredding documents. Well, now people have shredded it all up because they've been with us for so long. So now it's just an excuse to get together. All of these parties that we have, these engagements, are just tricking people into conversations about going into their situations. When I say tricking them, I don't mean in a deceptive way, but people don't make time sometimes to talk about finance. So we make it fun, we make it enjoyable, we make it engageable. So it's just very important to make sure communication happens.
Absolutely. And I know that people that have been working with you for years have commented that they feel that when they do actually reach out to you, that you're always there for them, that you take the time. They love that you're so compassionate and that you listen to what's going on in their life during that time, because as we've talked about, people go through life changes, especially with what we went through in March. With COVID-19, there were a ton of life changes going on at once.
Yeah, we live in a really crazy time right now. But you know what? The honest truth is COVID made us more efficient.
Yeah.
So our ability to communicate, some of the Zoom stuff, we have a lot of clients that are snowbirds still, and we're able to engage with them when they're back in Ohio or Wisconsin. We're able to have those visual conversations with them with a video chat that we never even thought about doing before. So it's normalized some really cool technology.
Absolutely. Well, Stewart, we're about ready to open up the phone lines for the very first time this week. Do you want to tell the viewing audience what they can expect to receive by calling in today?
Absolutely. So for the first 10 callers, what we're offering today is a complimentary portfolio analysis. And in that analysis, what we'll do is we'll take a look at all the fees, the expenses, the risks that you're taking in your portfolio, and also find out what kind of additional services are you getting in return for what you're paying. But if you just call 833-652-7829, I'd be glad to help.
Stewart, thank you so much. To the viewing audience at home, the phone lines are now open. We actually added the additional phone line this week for your convenience. We realized in the past the phone line had been busy. So again, you have 2 lines to call this week. The number is 833-652-7829. We have 10 spots available today for the complimentary consultation. We do have to take a very short commercial break, but when we come back, I'm going to have more questions and answers from Stewart about planning your perfect stress-free retirement. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. I think it brings a smile to their face.
we get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's managing partner of Asset Preservation Tax and Retirement Services. Stewart, a great first segment, and I love all the information that you've shared with the viewing audience. We haven't talked a lot about bonds, and I want to ask you, how much of a person's portfolio should consist of bonds, in your opinion?
Well, it all depends. Bonds have always added historically this really nice ballast to the portfolio. But remember, bonds are typically known as kind of the safe investment. Well, we're in a really unique environment now where we're at, interest rates, the 10-year Treasury is under 1%. I mean, we were at, 60 basis points, 0.6%. We're in the lowest interest rate environment ever. I mean, it's just insane where we're at right now. And so what's happened, you have to put it into proper perspective. When interest rates fall, bonds appreciate in value, right? So if you buy a bond that's paying 10% and then next year interest rates drop and the new bonds are paying 8%, well, your bond is going to become more valuable as interest rates fall.
So it's kind of like a seesaw effect.
Kind of, yeah.
Okay.
And so for 35 years, though, we've seen that dropping interest rates. Well, now we've just hit this floor. And don't get me wrong, a year and a half ago or so, I thought we were at the floor before in terms of interest rates. But we are, unless we go into sub-zero territory, we are in the lowest interest rate environment I could ever foresee. I've been wrong before, but as interest rates start normalizing and climbing back up, that's going to provide some really substantial risk to these big bond portfolios. So I remember a friend of mine in college, her dad just said, hey, once you make it, just buy municipal bonds and you'll get your yield, you'll get your money back when they mature, and it's tax-free. The problem now is, do you really want to be investing in municipalities that are having such financial difficulty, right? I mean, we're seeing states and city districts that are having incredible financial difficulty right now because of COVID. So just remember what you're investing in. Even though they call it a bond, you have to make sure that the underlying issuer is financially solvent and strong and so forth. And most people just don't pay attention to that. And what we're seeing now with people that are buying new municipal bonds is we're seeing advisors that are buying up their rate. So clients look at what's on the surface usually, and they'll see this bond is making 5.2%, and they're happy. But they realize that they didn't pay $100 for that bond, they paid $110. So they're paying 10%, 15% above the value just to buy up the rate. So they're not really making 5 or 6% on $100. They're making, they're doing it on 110, and they're paying way more for that, and it's tricking people. So I think people are thinking in their minds, they're seeing these high yields on their bonds, but they paid above market value for it or above par value for it. So
interesting.
Yeah. So as interest rates raise, I think there's some substantial, value risk to bonds as well. Not to even mention default risk.
Absolutely. So I want to also ask you a question. Should we be concerned about the government's deficit right now as investors? What's your take on that?
Well, yeah, so there's some definite inflationary concerns. That's why, I have clients that'll say, hey, we need to buy physical gold because they saw some commercial, and the reality is that it's really expensive when people start buying those kind of physical assets, because generally when you go and buy physical gold, you're paying 10, 15, 20% above what they call spot price, or the price of the value of the gold. And then to sell it, you're paying 10 to 20% as well. So just remember, if you combine those buy and sell expenses, right, you feel like it's the old stock market where you used to have to pay 4% to buy in and 4% to sell out. Now you're going to pay 10, 20% each way on gold. You have to make up 30, 40% just to break even. So we incorporate those kind of assets that are, more inflation sensitive into our portfolios, but we do it at a fraction of the cost inside our ETF portfolios.
Okay.
So, what costs you, 40% to get in and out of costs us 0.25% a year for the ETF cost. So there's way more efficient ways to do it.
Okay. Stewart, in your opinion, is there a certain age that people should start limiting their exposure to the stock market?
Well, as you get older, first of all, it all depends. It depends on what your risk tolerances are, what can you afford to lose, etc. But as you get older, it definitely makes sense to make sure that you have more assets that are immune from any of that market volatility. So there's different vehicles that do that, but absolutely, even though I'm supremely confident in our money managers' ability to navigate around this volatile world, the reality is that we never want all of our clients in the market. And the reason is it's kind of like when you're in Vegas, right? Remember, the stock market is a buy-sell relationship. You're buying something that someone else sold you. It's not just this infinite amount of companies that are being created. So if you bought it, someone sold it to you. They believed it was going down, you believe it's going up. And that sort of, tugging situation back and forth creates some volatility, but you have to be willing to make sure that your asset allocation is meeting the client's risk tolerance levels. And it gets, you definitely want to take some chips off the table as you get closer to retirement or deeper into retirement.
Okay. Are people often shocked to learn how much risk they have with, let's say, a portfolio that they bring into you and you're doing the analysis and the stress test, if you will? Are they often shocked at the amount of risk they're actually taking? Oh,
they're just baffled by it because, they're saying, hey, I'm conservative. Yet, if we stress test their portfolio and we replicate 2008 inside their portfolio, they're taking a 52% loss or a 45% loss. Yet, when I'm doing the portfolio analysis, what happens is we get statements, then we do the analysis. In our second meeting, we actually deliver the analysis. We interact and talk it through. And the first question I ask invariably is, how much are you willing to lose? So if someone has a $500,000 portfolio and I say, are you okay if you lose $5,000? Well, yeah, of course. How about 10? Yeah, I don't like that, but okay. How about 50? I don't know, that's there. How about 100? Yeah, no, 100, no chance.
Yeah.
So basically they're saying that, somewhere between $50,000 and $100,000 is their limit, which means somewhere between, 10 and 20% is the maximum threshold that they're willing to lose under any circumstance.
Okay.
Well, if it tests out to be 45 or 50%, it doubles what their drawdown limits are, right? So people are usually completely, just detached from the reality of the risks that they're taking. Because, and quite honestly, a lot of advisors don't even stress test their own portfolios.
Wow.
Right? It's really important to understand what your portfolio will do if things go poorly.
Absolutely.
And in these times, it's super important to understand those risks.
Well, Stewart, I think it's about time for us to open up the phone lines to the viewing audience again. I'll give you a break from talking, if you don't mind. To the viewers at home, the phone lines are once again now open, and we have 6 complimentary consultations left. The number to call is 833-652-7829. Stewart is offering you the availability to come in and actually have a stress test done on your portfolio. Have a full analysis. Make sure that what you currently have is going to work for you, not only today, but 5, 10 years, maybe even 20 years down the road, depending on where you are. Again, the number to call is 833-652-7829. We have 6 complimentary consultations left, and we'll be right back after this very short commercial break.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He's managing partner of Asset Preservation Tax and Retirement Services. Stewart, another just incredible show, just full of information. I have a question for you. If someone is in the viewing audience right now and they're wondering what is the best way for someone to diversify their risk and reduce volatility, what kind of advice would you have for that person?
Well, I think the important thing is to first understand what your risks are, right? And, you know, a lot of people, I had a client that came in, had 175 different individual positions in their fund. It was the report that we did on them was like 250 pages. It was unbelievable. And so when people have all of these positions, they realize, oh, all my eggs aren't in one basket. But what they're not realizing is that there's so much overlap in those portfolios, in those sort of funds, that when you have that many variables in a single portfolio, there's no possible way for an individual advisor to manage that amount of risk. It just becomes very, very, very difficult. That's, you know, just overcomplicating, you know, something that can be really simple. Okay. So I think it's really important to first understand your risk. And once you know what that risk is that you're taking, the question is, does it need to be reduced? What do you do to diversify that? Well, one thing we do is we just take a different approach to money management. We take a tactical approach. So it's not about just buying asset classes. It's about buying asset classes and having diversification that is relevant to where we are in the business cycle. So it's really important to make sure that you're buying at the right time in the right place. And we're not talking about market timing per se or day trading. We're talking about just making sure that the underlying investments you have truly are diversified relative to the environment we're in.
Okay, absolutely. Do you ever recommend that someone does a test drive of their retirement?
Well, so there's a couple ways that we can do that. I mean, we do that with our stress testing, but what you don't want to do is, you know, it's kind of like going to Las Vegas because you read a card counting book and decided, hey, I'm gonna go win. I'm gonna kill him at blackjack. We're gonna be awesome. You know, here's an example. I learned to play craps, and the worst thing in the world happened to me when I played craps for the first time in Las Vegas. I remember we were at this at Sam's Town in Vegas, having a great time with some brilliant people, and I took $1,000 out of my pocket, put it on the table, and literally, like I said, the worst thing happened. My $1,000 turned into $10,000, and I was having a great time with some great friends, saying that, you know, this isn't going to be Sam's Town. This is going to be Stewart's Town by the end of this night because I'm going to own this place. You know, I was just killing it at the tables. Yeah. But literally by the end of the night, I'm digging back into my pocket to add more money to it because the odds are the odds, right? Yeah. You never want all your chips on the table at one time. Yeah. And sometimes just remember, everybody can go on a good run like I did that night in Vegas. I'm the worst gambler in the world. That's why I'd never do it anymore. But the reality is that when you when you realize where we're in the stock market right now, we have this amazing 11-year run. And people believe that they're these amazing investors because they've made all this money in the market. But here's the reality most people aren't facing. Everybody's done it, right? And if you haven't done it, if your money hasn't quadrupled in the last decade, there's something definitely wrong to begin with. And if you have done it, well, guess what? Everybody else has done it too. The magic, the secret sauce of finance isn't about doing well when the markets do well. It's about not losing when the market loses.
Okay.
It's about mitigating that risk, about not being willing to take losses that everybody else around you is taking. That's the most important thing in our opinion.
Absolutely. You could not have answered that any better, Stewart. If someone is in the viewing audience right now, and let's say they are 10 years away from retirement, what should they be doing?
Well, 10 years out, right now is the time to really solidify their plan. Right?
Okay.
As you get closer, it's even more important, obviously, to just, get in, whether it's with me or another advisor, start making a plan. The first thing you need to do is make sure you know who you're dealing with when you're creating your plan. Are they a fiduciary? Number one question, yes or no. If it's a no, you've got to move on.
Okay.
End of story, right? Number two, can they do our planning for us? And I don't just mean, financial planning, selling you investments. I mean, doing real planning. And quite honestly, our tax office over the last decade has been a tremendous game changer. And I feel like it's a little bit unfair to have that advantage in our industry because we're able to give that really deep advantage and that deep view into what their tax scenario will look like, not just today, but over their lifetime. So make sure that you have that tax plan in place. It's super important.
Okay.
Is your estate planning done? All those things really, really matter.
Okay. Stuart, with less than a minute left of the show, I'm going to let you tell the viewers one more time what they can expect to receive by calling in today. All
right. Well, if you call in, what we'll do is we'll offer you a complimentary portfolio analysis where we'll take a look at all the risks, the expenses, etc. in your portfolio. We'll also take a look at what kind of things have been overlooked in your current portfolio. But if you just call 833-652-7829, we'd be glad to help.
Stuart, thank you so much for your time again this week. To the viewers at home, thank you so much for watching and spending time with us this week as well. The number to call once again is 833-652-7829. We hope you have a great week ahead. Be happy, be safe, be blessed. We'll see you again next week. Thank you.